Hi, folks. This is Sean Hyman from the Logical Investor newsletter. And I want to emphasize a portion of our latest newsletter to ensure that everybody's had the chance to see it. You should have all read it thoroughly and not skimmed it, because if you're skimming them, you're gypping yourself. And it doesn't gyp me, but it gyps you. So maximize what you pay for. Read every word. It's one time a month, and nothing is put in there for fluff or to add content or to make something look long or whatever. I've got total liberty on how long each newsletter is these days, and some are shorter, some are longer, and so there's never fluff put in them. So, in the newsletter, I was talking about how I teach people properly, but I've learned that people always divide themselves up into three types of people within my base of subscribers, due to how they choose to want to think, which is due to the wisdom level they've chosen, whether consciously or subconsciously. Some will hang on to every word I say and do everything I say. That's group one. And two, some will half-heartedly follow along while making up their own rules to add to it, which I call those tweakers, which I say is dumb. That's group two. And I've got a couple of tweakers on my site commenting just this week, and so it makes me think, did they even read the most recent newsletter? And then three, there are those that will subscribe and invest and not listen to what I say. They'll end up trusting their own emotions and therefore their own judgment versus that of a professional, and they'll sadly make the wrong move. They'll enter a stock upon my instructions, and they'll exit it upon their own whims or their own emotions that they're confusing with facts, and that's a recipe for disaster. And that's group number three. So there will always be those types of three groups of people, and I've always wanted, as a teacher, as somebody that is practically your cheerleader and wanting you to succeed, I've always wanted everybody to be group one. And for years it bugged me when people weren't, but I realized, when you dealt with different bases of people, different newsletters, different places, through different publishers, different parts of the world, different, races, sexes, whatever, they always fall into these three categories. And that's when I realized, and it took me a long time to get that. And it's still a truth that I even don't like to know is true, really, because I, in my heart, want everybody to be group one, because I know that's where they're going to have the greatest, success. So, this week, I had a couple of people, tweaking the system, saying, well, I know you said exit here, but here's how I exit. Or, well, why don't we just wait until the third round of investment to ever invest, and I'll give a grocery list of reasons why that's wrong thinking and stuff like that, not to mention how many opportunities you're going to miss out on, and how much you'll have a lack of diversification, how much slower you're going to grow your portfolio, and how much more apt you are to not succeed and trying to be overly cautious. So tweaking a system is saying, okay, Sean's probably got a pretty smart system, but I'm smarter and I can make that. In other words, smarter in investing. I'm sure there's plenty of subscribers that are smarter than me in intelligence or in other areas of life or what have you. So, but I mean, smarter in investing. And so it really is a lack of wisdom to say that, because if you're subscribing, it's because you either are new or you haven't, or you've been investing for a while and you haven't had the results you wanted. So you subscribed, you paid the money, and what did you pay for? Tenure, experience, maturation of thought process, things like that. So then when you pay, you listen to that, and then you go your own way with your own thinking, which seems right and sounds right to you, as all novice thinking does, until you really put some experience to it. And you succumb to that by choice versus following the mature thought process, which is tougher, I agree, because what you constantly have to do is you constantly have to exchange your level of thinking for a higher level of thinking. And again, I'm not a higher level of thinking than y'all in every aspect of life. Not saying that all would never say that, but if you're following me, if you're subscribing to me, if you're laying down money to subscribe to something, it should be saying, I believe that Sean has a higher level of thinking, a more of a mature, sound-minded thought process and system than what I've had in the past. Therefore, I'm going to trust that. So it's dumb, and I know it's a strong word, but it is dumb to lay down money to get advice like that and then not follow it. It's like I said last week on the weekly video, it's as dumb as me going to the doctor and, I've got a pain here and this, that, and the other. And he analyzes it and he x-rays it and he looks and he does everything he needs to do. He says, okay, here's what you need to take. Take this, antibiotic, take this, whatever, lay off of this, do more of this, whatever. And he tells me exactly what to do to cure it because he's seen this thing hundreds of times, maybe thousands of times. He knows what works and what doesn't work. And then I go, well, thanks, Doc. I really think this is the deal and I'm going to do this. And the guy would be scratching his head saying, I don't know why you paid your copay and came in here to waste my time, So it's equally as dumb to do that in investing. And that's why I literally provided the link to all the system tweakers out there, because I know it's a natural inclination to want to do that. It's a novice thought process here's what novice thinking does. Novice thinking is like wheels that are out of alignment. It's always wanting to pull you to the ditch. And so it's like a back that's out of alignment that a chiropractor needs to skillfully realign. That's what novice thinking is. So you can literally click on that link there, which is in the Ask Sean page. It's been there about a year. It says, beware of your natural tendency to want to tweak our investing system. So it's not that, I'm jaded and thinking, oh, Sean, thinks he's got the angle on everything or whatever. It's like when I've developed something and it's been thought out from so many angles for so many years and it's been proven for so long, why would we go tampering with that? So I would encourage you, to not, tamper with it as well, because we're going to have the system tweakers, which is why, again, on the Ask Sean tab, you scroll down and, right here, beware of your natural tendency to want to tweak our investing system. I would encourage everybody to go through that video again because it will help you tremendously. Another thing that happened this past week, I had a lunch with a guy that he's a young guy and I've kind of helped mentor along because he's friends of the family and friends with his parents and stuff, and he was talking about how this one guy had one of his friends had made all his money in tech stocks and didn't know what he was doing, but somehow was making all this this money. And it reminded me of the stories that I would hear as a stockbroker, in 1999 and 2000 and 98 around in there, when you're at the last, one of the last toppy phases of that particular bull market. People were quitting their jobs. Everybody thought they were stock pro, and all they had to do was go buy AOL or Dell or one of those stocks like that at the time, and they just felt like it was a no-lose situation. All this stock could do was go up, so it was just buy every dip. They didn't have an investing philosophy. They didn't have an investing strategy. What they were was subject to an up market. So it would be like me hopping on a piece of driftwood in the ocean and the tide is coming in, and I think I'm doing something amazingly because me on the piece of driftwood is heading towards the shore. Oh yes, I'm so amazing. And it would have nothing to do with me being on the piece of driftwood as much as it would the tide. The trend of the tide was rolling in to shore. And then they don't realize how much of a genius they're not when it comes to investing. Again, they might be a genius in so many other facets of life, and that's awesome. But in this one particular area, they don't realize that they're not such a genius until the tide rolls back out, which is the trend changing in the market, and they get spanked big time and lose a ton of their assets. And probably even some of you have done it in the year 2000, year 2008, 1987, different things like that. So that story, encouraged me to share that with you guys to beware of being that guy, because if he doesn't change, he's going to get spanked, and he doesn't realize. And tech stocks turn harder and quicker than many stocks. So when the trend really turns, man, it turns hard for tech stocks. And so they get spanked so much quicker than the average investor. And all those gains that they theoretically have on paper get erased real quickly, and they go into losses, and they're left scratching their head as to why or what happened. Then they think the market's out to get them, and it's amazing. The market wasn't out to get them when they were supposedly making all this money, but now the market's out to get them, or it's always somebody else's fault. By the way, that's group 3 thinking, is, when they start off following something and then it doesn't work out for them, either because they got emotional, rational, or whatever, they always want to blame it on somebody else. It's always got to be somebody else's fault. It's always somebody else that's a crook or the scammer or the misleader or this, because it can never be them. And when there's that kind of thinking, it avoids self-analysis. It avoids calling our own selves on the carpet and see what we did wrong. When it's always somebody else's fault, see, we never have to change. And so while it feels good for something to always be somebody else's fault, we're left stuck in life because we don't progress and grow, because we don't self-analyze, and we don't change our thinking, our thought processes. We become excuse makers, and at best that puts us in neutral, and at worst it puts the car in reverse in life, and it's not a good thing. And it's that way in relationships, in your money, investing, all kinds of different things. The last thing I'd like to say also is, every once in a while somebody comes on the site and posts something highly emotional or highly ungrateful or whatever, and just know, when you are going to come on my site and do that, just know I'm going to pop you right between the eyes. So it doesn't mean you can't do it, but just know you're going to get a strong response from me. And it's not to be mean. It's not to get at you. It's always to sober you up in your thinking, to shake you out of your crazy mindedness at the time. So, and I would rather the person unsubscribe than to be an emotional cancer to the rest of our group by being overly emotional and choosing to be that way, by the way, or choosing to be ungrateful, but because both are inexcusable. Anybody can get that way at times, but you better be open to correction when it happens, because if not, one, you're going to suck in your investing, whether you're with us or without it, outside of us, because your emotionally led investor is never a successful investor. And ungratefulness is just plain bad. So I would rather you not be with us than to be ungrateful for all the time that's been spent, all the hours that's been put in, all the, time I put into weekly videos, all the time I put into monthly newsletters, the countless questions that I answer through the years. If, if making gains and you're ungrateful for that, I don't know what to tell you, because that's something that only you can change. And it's hard to come out of ungratefulness back to gratefulness. It's why I never want to go there, because it is tough, because it's hard to, because somebody else can't kick you in the butt. You really have to kick your own self in the butt and come out of that state of ungratefulness back to gratefulness. And that's a hard thing for a lot of people to do. A lot of people won't kick their own butts. And a lot of times you have to kick your own self into action and change your attitude. And so just know, if it ever gets that way and you're saying stuff like that on the site, just know I'm going to call you on it. And it's not to be mean, but I've got a lot of people's lives and interests to guard, and I will guard it like a freaking hawk. And so I won't allow people to become emotional cancers on the site and stumbling blocks to those who really do want to learn, over the very, very, very few, thankfully, that want to be overly emotional or ungrateful. And thankfully, it is a very, very, very small, percentage that chooses to go that route. And of that, I hope 100% of those turn around and go back from emotional to logical investing, from ungrateful back to grateful. That would be my hopes for 100% of the people that go that way. But I know some will choose to, some won't choose to, even though it would be my prayer that they all would choose to. But in the end, it's up to them. They've got a will. All right, now let's get on to the markets. So the S&P 500 has a couple of points of resistance that I had talked about, that I'd shown on hourly charts, and one of them was basically this area right here, that for a couple of months now, the price has been rejected here, here, and here, but then on its next attempt here, it busted through this area of sell-off. So I looked back to the next time when there was a massive sell-off, and it happened around the 3,000 to 3,030-ish area, 3,000 to 3,020 for the most part. And here we are again at that area. Now, it doesn't mean that it can't surpass that area, but it is an area that I'm watching to see if the market has the near-term strength to push it through that or not. If it does, I still believe that if it pushes above it and still heads, much lower, or it could fail at that area and head lower. But I think those are the two most probable paths right now for the S&P 500. And if this goes higher, what does that mean? PE valuations just got higher, risk just got higher. The inevitable shrinking of PEs through stocks falling relative earnings still has to happen, and the risks become higher the higher those PEs get. So some people have wrong thinking and thinking that, oh, if the market went higher, I should have been a part of it. But at what cost or expense? It's one thing if the market goes higher and you're at a PE of 10 or 12 or 15 or something like that. It's another thing if the market goes higher and you're at a PE of 22, 23, 25, etc. You're taking on insane risks that are valuations of previous crashes. So to me, that's dumb. When you're trying to, it's your greed thinking right then that's trying to squeeze the last drop out of the lemon, and you're risking getting run over. It's like in Wall Street they say it's like picking up pennies in front of a steamroller, and you're going to get some pennies, but you're also usually going to get crushed on your way to doing that. And so it's a person's internal greed that wants them to try to squeeze every ounce out. And by the way, even that thought process is wrong of trying to squeeze every ounce out, because that assumes that they'll know when every ounce has been wrung out, which assumes that they'll know when the top is, and assumes they'll know exactly when to get out. And if professionals like Warren Buffett and Sir John Templeton and Peter Lynch and all these guys couldn't do it, that built their whole careers, that's all they did as a profession, if they can't do it, and I know good and well I can't do it, I'm not sure why you would think that you can do it. So it's a fallacy. It's a lie that's believed, and I would urge you to not ever be a part of that thought process. So S&P, still I believe ultimately heads lower. It has to over time because of its PE valuations. Here we are on the weekly chart, far stretched away from the 200-week moving average. Eventually those come back to those moving averages, but when you get to the final end of that final bull run, the moves don't stop at that average. They may bounce upward, around those averages at some point, but they head much lower than that. So matter of fact, while we're talking about that, let's go back and look at the last couple of downturns to see what that looked like. So here was 1999, 2000. And it comes down and it bounces off that region, but then goes far lower than that 200-week moving average that formerly had always supported that trend. Matter of fact, let me just go back further so that you can see that move. So here you go. Here's your, this trend seemed like it was going to go forever. Seemed like, they couldn't lose. It was this strong, long, vivacious bull market that seemed like would never end. And every time it ever came back down to the 200-week, like here and here, so forth, and even closer to it, like here, people would buy those dips. And so they're buying the dip here, and it bounces a little bit, and they think, I'm a genius once again. And then it goes far lower. So it goes from 1553 to 768 from its top to bottom. Then you get your next bull market run. And this one, it touches it here. It doesn't even end up touching it here. And the next time it touches it here, it bounces up some and then falls back down again from 1576 to 666. What a number, huh? It goes far below that 200-week moving average. So here we are again, touch it here, touch it here, touch it here. There's one of the upcoming uh, moves that is going to go far below the 200-week moving average. By the way, when these things were happening like this, there was forewarnings. When you see the weakening that was happening in the RSI, this one showed it a little bit in the MACD as well. Here you had this moving up, and you had this happening here in the RSI. You had this happening in the MACD. Part of it comes before the turn, and part of it confirms after the turn. What do you have right now? Same thing happening, right? Yet people are ignoring it because they see prices higher. Yet this slowdown in momentum, which is what the RSI and MACD are showing, happens before trend change. So it's like I said before, if you are driving on a street and you need to make a left-hand turn onto another street, what do you do first? You let your foot off the gas pedal. You apply the brake. What are you doing? You're slowing down your momentum in that very same direction that you're presently going, in anticipation of a left-hand turn that you're going to make at the next intersection. So momentum change happens before direction change, and this is warning. It's a heads up. Momentum change is already starting to happen, and direction change comes next. And eventually, I mean, sure, this thing may go down at first, and it may bounce a little and stuff like that. Not saying it won't. And sometimes those bounces happen at the average, a little above it, a little below it. But ultimately, this is going to go quite a bit lower than where the 200-week moving average is. So, how much lower? That's any man's guess. I mean, there's support zones, at the 1800s level, which I personally think it will likely blow below that. There's another one at the around the high 1500s to 1600 area, which would be more likely. But yeah, there's nothing that even says it couldn't even blow far below those levels. But just think about from 3028, call it, to 1600, the move that would be, or even 1800, the move that would be. That's massive pullback in the overall market. And so people get numb to it when you're here, and when you're here, they just think that the next downturn's never coming, and they base it off of all this history that seems to have proved itself. But if you just monitor history, charts don't lie. When this happened, they didn't think this could come. When this happened, they didn't think this could come. And since we're in the longest bull market in U.S. history, of course, right now they think that this can't happen. Yet the RSI, MACD are both warning about it. The price being elevated from its 200-week moving average and being so long in the tooth in its uptrend, all screams to those who are listening that it's dangerous territory. So anyway, hopefully that's a little lesson for you and a little reminder. Let's go through our positions. So, by the way, if you were a tweaker of our system, you would have totally missed out on several of our 7 sells that we've already had. If you were a system tweaker, you would have never gotten in some of our positions that have already soared, like PPLT, for instance. So there's just so many great opportunities that you would have missed out, because the system tweaker always thinks that they're having a better approach, a more refined approach. Adding another filter or layer gives them an extra level of confidence and higher probability of success. But it doesn't, because one, you're going to totally miss out on some opportunities that take off when they're a point of value and never look back from when we enter. And you're not going to be as diversified. And also remember, we won't win every stock. And so guess what's going to happen? So you'll have fewer positions, and the one that you lose on will be one of the few stocks you hold. So it puts a bigger dent in your portfolio than it otherwise would if you'd had more positions and more diverse. It grows your portfolio more slowly, and there's just all kinds of holes in that. And you're still not dodging the the ultimate loser that we eventually will have, because an ultimate loser, if it were on its way to zero, we would have our three averagings in, and then it would continue to go to zero. And that's why we don't do any more than three, and we keep them all at three. But if your thought process is only invest in ones that go to three, eventually the attribute that the loser will have will be that you would have gone through one, two, and three and on to zero. And again, that's going to be super rare. In all of the years of the Ultimate Wealth Report, only one company ever did that, and that was one that Obama personally hammered the coal sector and personally drove it into bankruptcy, and just strangled that industry. So those things will come out of left field and occasionally happen. Of course, that was also one that we said from the get-go that I stated was more of a speculative turnaround play. And so that's been the only one that's happened like that thus far. But nobody wins everything. They don't. The Oracle of Omaha, deemed supposedly the world's best investor, he hasn't won on everything. Excuse me. Everything that he touches does not turn to gold. And it's just the media highlights more of what he gets right. So, but if you study his history, and don't take my word for it, study out, he's made bad moves before. And he's made bad moves in even some solid assets, and he's made some bad moves in assets that turned down and became bad. So everything he touches doesn't turn to gold. Nobody will win everything. And so you have to set your expectancy for, I won't win every stock I ever move into. Every stock I ever touch won't have a positive return, even though my overall portfolio will, because our system works overall. In other words, the system isn't for any one individual stock. The system, it says that basically when I take this system and apply it to a range of sectors, a range of assets, and I'm diversified, overall that portfolio is going to move forward and it's going to do great. And so therefore I don't have to worry about if any one particular stock makes it or doesn't, because it's the overall system with the overall portfolio that's moving my portfolio forward. All right, GLD is still on the up and up. It's too early to say if if the latest pullback is over and we go higher. If it does, emotionally that kind of takes care of itself. But it also could be a deeper three-wave pullback where you have something deeper that happens before heading higher. Anything like that's always possible. So just know that. We expected a pullback. I've been telling you a pullback is needed and coming. And also I've said when there's volatile upside, there's also volatile downside, even within an overall uptrend. And no sooner than I'd gotten that out of my mouth the next day or two or so, that started to happen. But there were some early warning signs that showed us that was likely, on its way. The volatile pullback, the RSI taking a step back, the MACD temporarily softening, and things of that sort, and the price being very far away from the 200-day moving average. But there will be a resumption of the uptrend after the dip, no matter whether it's a shallower dip or a deeper dip, and head higher. So very bullish on GLD. Again, all the China stuff, the trade war, sanctions on different countries, the debt loads that are increasing, the global economy slowing down. I mean, you name it. There's all kinds of reasons why GLD and other metals should and I believe will go higher. FXB was one of the ones that I told you that I believe is likely come to the end of its latest down leg, and that's based off of this leg being broken to the upside. So it rallied up to that, paired back, and then pushed higher than that. It's also above its 50-day moving average currently, although that could always have some sort of pullback first before heading and continuing higher. So just know that. But the RSI is strengthening. MACD is strengthening. It broke a downtrend, as well. The selling volume continues to die down. So there's all kinds of reasons why we are bullish on the British pound. So again, it's a pocket of value that a lot of investors don't even know to be in. EWW, of course, most investors wouldn't be in Mexico. They wouldn't even know to be or dare to be on their own. Um, so your latest ABC correction has already happened, and it's was broken here, came above 50-day, came above 200-day moving averages. Now it may consolidate, there and then move higher, or it may pull back, some and then move higher. This requires very little emotional management. This requires a little bit more, but not a ton more. This required the biggest amount where it dips here, but still had a higher low than what we had here. So it rallied up, three-way pullback. Now we're ready for our next rally up, I believe. So the MACD also broke a downtrend line. Selling volume continues to lessen. All kinds of positive signs out there. So very bullish on EWW. Again, it's a part of the world that a lot of people aren't invested in, and so very bullish on it. So here was one that one of our subscribers got really emotional on because this happened, and again, I've shown them charts pretty much on a weekly basis where when you look at LPL on a weekly basis, massive moves down, massive moves up, massive moves down, massive moves up, massive moves down, and some of these are dive off a cliff moves, and yet when this dives off a cliff, people think it's going to 0, and it goes from 7 to almost 17. Dives off a cliff here, goes back from 8 to 17. Dives off a cliff here and here. So they, but if you just, again, if you attach your emotions to every wiggle and squiggle on the chart, you're always going to be almost manic depressive. So it's why that in our system, it's based off of fundamentals firstly. Fundamentals firstly is what it is as a business. It's fundamental soundness, it's fundamental valuations, etc., and then technicals and sentiment after that. So when this is happening, people think this can't happen. Matter of fact, when it got called, a real dog, which was the quote, that happened basically right in there. And then, but yet, was that fact? No. I mean, even since it's gone up, like 20% since the real dog comment. But it's just how the person felt at the time, which was confused with fact. And that's the problem that's why I say your emotions are not your friend when it comes to investing. They will have you confusing emotion, which you feel so strongly about. Therefore, it must be fact. And it's where your emotions really lie to you. And it's a fallacy. It's a novice investing mistake, and people just shouldn't fall for it. And it's the reason why I harp on it so much. So the selling volume keeps dropping down. In a MACD buy signal, you've got the MACD's broken a downtrend there. You've got your RSI's been strengthening, and so forth. So now we've had quite a run up here from below 525 up to 649. So percentage wise, that's a pretty good move. So just know there could be some steep and volatile pullback, before you get your next thrust higher. Just know that can happen. It can go deeper than that. It can be shallower than that. So I'm not drawing a line saying that's where that stops. I'm just giving you an overall direction of what is probable, because these things vacillate up and down a lot. And if they can vacillate down a lot, they can vacillate up a lot, but they can also vacillate back down a lot, etc. So I'm looking for volatile swings, but overall on the up and up in the coming months to year or two. And again, very bullish on it. Apple just announced their new iPhone and so forth, and these guys are making screens for iPhones and iMacs and stuff like that and all. So very bullish on on them as a company. So then we've got BBBY. By the way, the people that get most emotional and that focus on the biggest percentage changes are also the ones that will be our single digit stocks, because when something goes from 6 to 5, that's a bigger percentage difference than when it goes from 15 to 14, right? So the percentage differences become greater the cheaper price per share that stock gets. Conversely, what they're also not thinking about, because then they're like, yeah, but the stock's then got to make up X percent. Yeah, and when it goes from 5 to 7 or 8, what kind of percentage gains are those as well? So it's all relative. So, um, it's why you can focus on the wrong things, and it just totally consume your thinking and really vex your thinking, and it's just it's not a good thing. So I used to think a long time ago, man, if I tell people what my system is, they'll just run off and do it, and they just got my system for free, and they won't need me anymore, and all my years of experience, just it doesn't benefit me much at all, and stuff like that. And then I realized, one, if you give people a system and they run off on their own, they're going to tweak it, they're going to usually screw it up, they're going to mess with it to where months on down the road, if not a year on down the road, they're nowhere near the system that you had given them in the first place because they veered off course from it. And secondly, my thought process was, if I ever did a monthly subscription, it would backfire on me, because somebody could sign up for a month and get our picks and then cancel. And then I realized that they would suck wind just as bad, but then, because they've got the picks and they don't know when to exit them or how to exit them, and meaning when's the right time, and so they'll end up screwing themselves over, because they'll on some dip that happens that they're all emotional about, they'll cash out and make a loss, or they have no idea of when they should be considering exiting, because they're not knowing the long-term resistances, Elliott wave counts, this, that, and the other, and so they're totally messing themselves over that way. So while I know, as I go to our new monthly model, and even as I tested a monthly model here, I know that there will be a few people that'll go that route and try to cheat the system, so to speak. But I've also learned that most of the subscribers will have good sense and realize, hey, I want to pay for these ongoing insights and handholding because it's benefited me through the years, and so I've made thousands on something that costed me a couple $100 in a given year, and so I'm reaping far more in profit than Sean's ever requiring in fee, and I'm maturing my thought processes along the way. I'm getting reminded of stuff that I need to be reminded of. So here was another one that subscribers got emotional about. Again, some had averaged down enough to where when this run up happened, they were able to exit. So some of you weren't even in this, but many were. And so when this happens, of course, what do they think? They think it's going to zero. Why? Because they're getting fixated on a price on a chart, and they're not fixated on fundamentals. If you go to fundamentals, you're not thinking the company's going to zero. And if the company's not going to zero and has value, then there comes a time where it turns around and heads right on back up. So so this is one that those of you who are in should have all of your three averagings in. And again, this is one where some got emotional about right in here, calling it a dog or a bad pick or this or that or whatever. And, what do you have here? ABC correction lower. And when do people get emotional? When do people get off track and go in the ditch the most? Wave C, wave 2. So, so as much as I've said that, I've said it so that you avoid that thinking rather than get sucked into the vortex of that type thinking. So you don't have to ever become the thinking of a wave C or wave 2. You can say, oh, this is how I feel in this, but I don't have to feel that way because this is wave C or wave 2. That's how the masses think. They make stupid decisions. I'm smarter than that, and I've had better teaching and counsel than that. So, and I've been warned against that. So I'm going to do, I'm not going to go with my feelings, because your feelings make horrible leaders. The people who say they fell in love and fell out of love, what they're doing? They're following their feelings rather than their commitment. So your commitment is that you made a covenant before God, and you stood before people and you made a covenant with God and with your wife in front of a preacher and in front of a crowd. And so there will come a time where that will be tested. You can either follow your commitment, which has nothing to do with emotion. It has to do with a quality decision that you made, or you can go off of emotion. Well, I used to be in love. In other words, I used to feel good about and with this person, and now I don't feel good about this person or with this person. So therefore, I must not love this person, and therefore I must need to get a divorce. So that's letting feelings lead the relationship. So feelings make horrible leaders. Feelings make great followers. So I have feelings for my wife, but I'm not led forth by my feelings. I'm led forth by my purposeful actions towards my wife. So I purposely say great things about her. I purposely, when I think good thoughts about her, I share those with her. I purposely build her up. I purposely do things with her. I purposely have us in church and things like that together. All strategic, nothing emotional, and probably not even romantic about it, but it has huge rewards in that as I'm purposely leading by strategic decision making, there are feelings that are on both parts of us that come as a result of that. So feelings are a follower. So we are able to enjoy the feelings, but not be led forth by feelings. And some days the feelings may be there, and some days the feelings may not be there. And my commitment level doesn't change on either one of those days. So it is with investing. So those of you who've been married 20, 30, 40, 50, 60 years, and you get that mode of thought and how rock solid you had to get in your thinking with how as it pertained to your spouse. So it is with investing. Same thing, different thing that you're doing, which is investing. But it's not an emotional led thinking. If you think about everything that you've been truly successful at, you never asked yourself how you felt about it. In other words, let's say you worked out for 10 or 20 years. If you ask yourself how you felt about it, there's plenty of times where you don't get up, you don't do anything, and you don't do it for that length of time because you got in the habit of asking yourself how you felt about it, rather than just getting up and making a decision Monday, Wednesday, Friday, or whatever your days are. I'm going to walk this amount of time. I'm going to work out with the weights. I'm going to do this. I'm going to do that. So rather than making a decision, it was on the feeling side of it, and the feelers never stick with anything and have true success at something, where those that make a conscious decision, strategic decision, do. So it's the same thing with investing. Focus on the fundamentals. Don't focus on every wiggle and squiggle on the chart, which can lead you, astray. So very bullish on BBBY and where it's heading over the long term, and believe it is a great pocket of value. CAJ, Canon, is another one that very volatile. It has big swings up, big swings down, big swings up, big swings down. But the latest swing lower looks to be over, as that ABC downward move has ended, and we have come back from the 2550s or whatever to over 27 presently. The selling volume continues to get lower. MACD buy signal, RSI heading higher. Do know that when you have these big surges, eventually you will probably have some big volatile pullback before heading higher. It could do anything like something like this. So just know that can and is likely to happen. But note that I'm expecting this over time to go far higher. So just know. Again, it's sound fundamentally. I don't lose a week of sleep about any of these positions. So KHC, by the way, if you notice, a lot of the stock market's been rolling from growth stocks to our value stocks even lately, and that's why you're seeing some of the recent surges. So this one has come from 26s to 29s. It's MACD foretold that was likely to come. It's like a selling volume. Its RSI has been strengthening, so forth. So this has been a nice push higher. Now at some point again, we're going to get some pullback before heading higher. So do expect that. Don't know when it comes. It can rally first and then have pullback and so forth. So any kind of combination of this type of stuff can happen. But just know we will ultimately long term, I'm looking for this to head higher. And then next we've got ticker symbol E. This week I put on, I believe it was the fundamentals news and chart section, but definitely somewhere on the site, about how Saudi Arabia wants oil to head higher, and how they changed out the oil minister to get them more focused on cutting production to get oil higher and to take that more seriously. They're also still wanting to launch their IPO of Saudi Aramco. And of course, Aramco needs higher oil prices to squeeze out as much value as they can out of any initial public offering. And so of course, they want it higher for that. But they mainly need it higher to meet their budgets. And so for both reasons, they want oil higher. Well, ENI will benefit from those higher prices. So right now, you've got Brent crude that had this run up from 27 to 86, which that's what the Saudis use as their benchmark, and they need it to go back to this level and at a bare minimum. Now we may have, this may be the end of the pullback, and this could be the next, push higher into that, or this could be a deeper ABC that does something like this before doing that. Either of those are possible, but we will get that next push higher. They're going to, I believe, see to it. The technicals keep firming up. The MACD is firming up more recently, and it's firmed up more overall. The price is above a rising 200-week moving average now, etc. So even if it temporarily dips well below that, I believe it's going to continue that average up by swinging back much higher. When the next major push to higher highs in oil happens is when a lot of certain former laggards like Devon, Devon Energy, Rig, Encana, Diamond Offshore, etc. That's when they will likely get their biggest boost when that next surge higher in oil happens, because some of those are deep sea drillers and they need higher prices for oil, just like Saudi Arabia does. Saudi Arabia just needs it to meet their budgets, not because it costs them that much to pull it out of the ground. So WTI crude, here was your ABC downtrend, ended back here. It's important to remember that, because it's easy to think, oh, the downtrend isn't over when these pullbacks happen, but it has. This is your ABC downtrend, ended here. This is a major wave 1. This is a major wave 2. We just don't know if we're done with major wave 2 yet. Again, it could head on up higher, or it could head lower before it heads higher. So 1, 2, 3, or 1, 2, and then 3. Again, same things happening here with WTI. You've got these prices firming up. You've got selling, which kind of peaked somewhere in here, and it is some lower here as well. So several things showing there. But anyway, as this surges into wave 3, ENI will profit nicely. Matter of fact, we can look at ENI on the larger scale, and what's it doing? It's following what oil is doing. Here was your downtrend that ended here. That's when it ended for oil. Here's your push higher in wave 1. That's what happened with oil. Here's the pattern with what oil's done since. That's what's happened with ENI. So, and you've got divergence higher there. You got divergence higher here. You got the increasing 200-week moving average. So, so I'm looking for this to head, notably higher, like that on its next push higher. So, so very bullish on ENI. And then after that, we've got SLV. This is one of the ones that somebody was getting ungrateful on, because they had held it in our UWR portfolio. Again, when does emotionalism tend to persist? Anytime through waves C and 2, and so when was that they were holding that through waves C and 2? So here's ABC. Here's one. Here's three-way pullback wave 2 that ends here. We are into wave 3 here, which should go, back to here and then some. So here we are. We went up to 1835. We pulled back to a little under 17. We could pull back some more in the near term, and then ultimately push higher in the months to year ahead or so. And that may come sooner, that may faster or slower. We don't know, but depends on how long or steep the pullbacks are. But ultimately this pushes higher. This is into wave 3 because it has broken this right here, and so the bottom of wave 2 is here. It confirms being in wave 3 here, so I'm looking for this to head on up. We are grossly overbought at the moment, so some pullback could definitely be warranted, but our MACD and RSI are both bullish. Again, in the LI portfolio where we bought it at, if it ran up to this area pretty soon, we would be up so much percentage-wise that we would be taking profits in that. But if you've held it from a previous portfolio and you're holding it somewhere in here and you've averaged down some, but your percentage isn't as high, you can follow that on up to something higher, because there's a resistance zone at say about the 25s or so that's very, very strong, and so you could ride it on up to 23 to 25 area if you're in that scenario. And with where you got it originally, and with averaging downs or getting into it where we got into an LI, your average break even should be low enough to where when you're back to that zone, you should have a very nice return. So this is the stock that was getting some of the ungratefulness from about, I've held this since here, and you're thinking about exiting here, and I only have this kind of return, boo-hoo. And it's an ungrateful type of tone, and of which somebody can choose to hold it longer. I've said it in weekly videos, and I don't know if they're not listening or not. I've said it again in this one. So if you're keeping up with the videos, I even still help handhold you through previous positions of a newsletter that I don't even run anymore, along with helping you in the present one. And so for that, you ought to be grateful. But if you're not, it's like I said, I would rather you unsubscribe rather than be ungrateful, because it's just uncalled for. Anything you're ungrateful for in your life ends up leaving your life. Don't believe it? Be ungrateful for your spouse. See if she stays around. Be ungrateful for your job. See if you stay hired. If you're ungrateful if you're owner and you're ungrateful for your client base, you end up losing them. If you're ungrateful for your kids, you end up losing them. So it's a key in life. Ungratefulness is like a cancer. You've got to eradicate it, because if you don't, it will only kill you in life. See, by ungratefulness, we think it's hurting the other person. It's not. It's hurting ourselves, because it causes us to miss out and lose out in life. So it's very biblical. So CHL. This one is looking good because it's broken this long ABC pullback here. So again, we got into it, or we let a lot of this sell-off happen and get back closer to the 200-day moving average. We put in one here at around in the 47s. I think it was high 47s, and then of course it's been 39, 40, 41 for a while now. So you've had more than ample time to have a very nice averaging down to bring that break-even price down to where when that price gets back, to these areas, we're able to close out of that, and you have a good return because of your lower average break-even price. So novices focus on trying to hone their exit, which means trying to call the top, which they can never do. And they think that their return is based mostly off their exiting price, and it's not. I've learned from Buffett, not by him teaching it, but by just me watching his actions and what he actually ends up doing, that your profit is really made on your buys, and that's why we employ the averaging down strategy. Now, it's not realized upon your buys; it's realized when you exit it, but it happens because of the strategic nature of your buys. And so, when you do your averaging downs, let's say you get in at 47 something, and you get in at 41, you're at break even somewhere in here. And so when you get back to those levels, you've made a profit off of that. Whereas if you'd have just gone all in here, which is what most investors do, you would only be back to break even here rather than profitable here. So rather than trying to tweak the system and say, well, I know Sean says to sell now, but I'm going to do X, which again is a group 2 thought process. I would encourage you to stick to what we're doing, because the averaging down process is where you are enhancing your overall return, not in how well you think that you're tweaking your exit. So, but again, very bullish on CHL. It's been heading higher, and naturally that's going to have some kind of pullback and head higher at some point. But the RSI has been strong. The selling volume peaked lately here and has been much lower ever since. So that has gone down. You've got your MACD that's hit a bottom here. It's broken. Downtrend line here, coming back above the 0 line, which is bullish. All kinds of bullishness. So I'm looking for this to head overall higher. Now, with that said, it's come a long ways from 39 to almost 43, right? So percentage-wise, in such a little amount of time, that's a lot of change. So just know this could have quite some pullback before heading higher. That can always happen. So just be ready for that. As soon as we get back to around where our original entry price was on that, because we've got a break-even price lower, we will probably exit that one, and we're doing it because of all the tumultuous stuff with China. Even though this is not affected by tariffs and things of that sort, because it's China doing business in China and Hong Kong, it's still we're being a little more cautious on that particular one. And then we've got PPLT. Again, this is one that if people are waiting for a second or third averaging, the train left the station without them. And so, I mean, we practically called the bottom on this. And when I say called the bottom on this, in other words, happened to call the bottom on this. And when I mean bottom, I mean recent bottom. So, so this took off like a freaking rocket. Many gap up days, and just seemed like a one-way bet to the novice. And I said, okay, this super volatile upside. I mean, this goes from 80 to 90 over 93 in just no time, a handful of trading sessions. That's not normal. So just know that volatile upside will also have volatile corrections as well. Now, we don't know if the correction bottomed here and it heads on higher. If it does, then that doesn't really need much emotional management. If you have a deeper three-wave pullback that does something like that before heading higher, that's where you need more emotional management there. But just know that even though it's volatile, it's in an uptrend: higher high, higher low, higher high, higher low, or higher low, and then higher high. So just know that's what we're looking at. If this soared, we got in at 80.27, and if this soared a little higher than these old highs here, we may look to exit it, because, I mean, if you got a return that's worth a couple of years worth of return in 45 or 60 days or something crazy like that, you should take it. Also, because additionally we are still in the metals trade overall by having SLV and GLD. So it's not like if metals continue to run on that we get left out of it. No, we still got legs in the game, so to speak. So we are we are very much still a part of the overall metals rally, even though we will, I told you from the beginning, my strategy was to be in all these at prudent times and then peel them off one layer at a time as this rally went up. And so we've done that with GDX. Many of you made 20 to 50% there. We will do that with SLV or PPLT, depending on what pops hardest and fastest the most. That with the way that platinum has been acting, that could be platinum first. But one of those two will likely be next, and then we will likely hold on to GLD the longest, and because I would like to hold on to it through quite a bit of stock market sell-off and correction to continue to have a iron in the fire there, and to have other locked-in guaranteed returns from metals that can't be given back from these other three positions that end up getting locked in before we ride out GLD for quite a bit longer. So again, it strategically has been done that way. It's going true to form. Now it's happening quicker and faster than I thought that it might, which, hey, I'm always fine with that, obviously. And I'd love to say, that our system is improved, or I'm better, or more on my game, or this or that, or not. But it's not. It's not. It's follow the system, and some gains will be quicker, some gains will be longer, and it's because it's the market that determines. So it's our job to find undervaluation and to get planted in it. And if it gets a deeper undervaluation, get planted in that through the second and third averagings. But it's the market that determines, in other words, and what's the market? The group of investors worldwide collectively that are invested in these assets have to come to the conclusion and realize, hey, these are undervalued assets, and run them up to fair valuation at a minimum, or to state of overvaluation, which is what usually happens. And sometimes markets are quick to realize it, and it can happen in rare cases in weeks or months. But in most cases, that's going to come over, 2, 3, 4 years. And in rare cases, that might be a 5th or 6th year or so. And that's just how real world investing works. That's why if you go to your broker, they'll tell you not to invest money that you can't leave in for 5 or 10 years. Because that's what you're going to need when you invest off of their philosophies and index, and buy the 20th of every month or whatever kind of a thing, and just let stuff sit, and you don't know anything about strategy or market or timing or valuation. You're going to need for sure a 5 to 10 year window. But when you're able to have a strategic system like what we've got, I can shorten that average window, and it is an average, from 5 to 10 years to 2 to 4 years. But when you put something in, you want to realize that occasionally you will have some of those positions on the far end of the bell curve that are a 5th or 6th year or so, and you're going to have a few positions on the other end of the bell curve that might be weeks to a few months or so, and those are anomalies too. That's not the norm. And then you're going to have the bulk of everything that falls within the bell curve, which is probably in that 2 to 4 year window. So just know that's how investing works. And it's like when you plant crops, and I'm no farmer, but I know from farmers, and I had friends that are farmers, sometimes you get bumper crops, sometimes you get crops that are less, sometimes you get crops that grow up and happen faster for you, sometimes they're a little slower. Certain types of plants shoot up and produce faster, certain types of plants shoot up and produce slower, just by the nature of what they are. And that's real world farming, right? And you may do the same thing. So in other words, the farmer will still till the soil, fertilize the soil, everything just the same like he would every year, right? Plant the same, everything. And in some years, he's going to get a bumper crop. In some years, it's going to look like, did he even know what he was doing, And it didn't have anything to do with him or his system or whatever. But there's just that ebb and flow. And there's also, different speeds with which each plant grows. And so it is with investing. You're planting money in the ground, so to speak, and that it will grow into a harvest. Sometimes you're going to get big harvest. Sometimes you're going to get okay harvest. Sometimes you're going to plant some seed that doesn't turn out. Just like farmers, every seed they put in the ground does not produce. Why? Who knows? Every once in a while you get bad seed, just like every once in a while you'll get a company that ends up going bad, no matter what your system. But overall, they're able to do it over time because they're diverse, right? Different types of plants that they work with, vegetables and different things. and vegetables and cattle and whatever they're raising, and through different years. And so they can capitalize on the bumper crop years to help them with the lower years. They can set back a certain amount more seed. I mean, there's just all kinds of ways that the whole thing helps them, but it ebbs and flows, and yet they can still prosper. And so it is with investing. So just know that. So when stuff's rocking for us, I'm not more on my game than normal or better than normal. It's the same system. I would love to say it was, but it would be haughty to say otherwise. It's not. And and some will take longer, and that's just because it takes investors longer to realize that that sector or that stock or whatever it is undervalued and a value, and to run it up back to a place of at least fair value, if not overvaluation. So anyway, that's it for this week. Again, we've locked in 7 gains in the LI portfolio. We have several more that are very profitable right now, and those are metals positions, and PPLT or SLV will likely be one of the next ones to be closed out and sold. Again, it doesn't have to be, because any stock can zip up tomorrow, and me not necessarily know ahead of time that that's going to happen, right? I mean, I would have never guessed when we invested in Foot Locker, for instance, that 3 weeks later we'd be taking a 27.59% profit, or 27.5%, excuse me. So I mean, things happen, right? So that are out of the norm, out of the typical. But if things went as the way they're progressing now, platinum or silver would be our next things to take profit on, which gives us more profits, more cash, ravaging down on other things as well. Okay, that is it. Again, the guys are still working on the site. They're still a week or two out, at least minimally, from getting that done. Then once they're done with their part, then my part begins. If I got to start loading that up with content, videos, and information and things like that. And so that'll take a while. So I still think we're at least a month or two away from switching over. Again, you'll still be typing in SeanHyman.com, and that'll switch over to the new site, because that'll be the redirect to the new site, and you can sign up there. Anything that you've got left over that's unused on your subscription here, it's my understanding that the publisher will change that for you. Just look at some of the most recent comments, and I've got the email for the publisher and the phone number for the publisher, and some of today and yesterday's comments. So, or you can just search the site using the search field. So, and then we'll be switched over to the new site, which I'll 100% control, and that will help me to recoup, a portion of income lost, and help me to build that back up to something a lot more long-term sustainable for myself. And so it'll be, in the end, better for me, and I believe better for you as well. All right. Thanks so much for watching, and God bless. Bye.